Hello and welcome to CFO On Demand. Please note our 2019 webinar series. We have our upcoming dates listed here. Please note for next year, we're going to change the date from Wednesdays to Thursdays, and we're going to also change the time. So we look forward to you participating and viewing our future webinars. Next slide. Okay, this month's webinar is Fraud, Protecting Your Company Assets, brought to you by CFO On Demand, Fitzpatrick Bongiovanni, and Kelly. There you go. All right, please support our sponsors listed here. This month's featured sponsor is Merrill Lynch, Autor Oakley Group, and at the end of the presentation, we'll have some comments from them. I'm Lou Bongiovanni. My email address is listed here. If you have any questions during the webinar or after you view it, please feel free to send me an email, and I'll be glad to answer them if you have any questions at all. Okay, what will we cover in today's webinar? Our objectives are to look at the primary fraud risk categories. We'll discuss the common fraud indicators. We'll also talk about the obvious and hidden costs of fraud. And lastly, we'll discuss the 7 ways to prevent fraud in your company. Let's talk about the definition of fraud, first of all, for purposes of this presentation. It's the use of one's position in a company to deliberately misuse or misappropriate company resources or assets. It's not only just theft, it's actually the manipulation of different resources or assets within the company. This triangle is common when we talk about fraud. Usually when there's a breeding ground for fraud, usually these 3 factors come into play. Number 1 is opportunity. Is there a lack of controls or an ability to conduct fraud in the company? Second, is there pressures on that particular employee, maybe internal or external pressures, in order to incentivize them to commit fraud? And lastly, is there a rationalization where they think such things as, I've been working here a long time, I deserve it, or I'm not getting paid enough or appreciated enough, and therefore they rationalize doing it not only once, but repeatedly. Little statistics here for you. Lack of controls, which is that opportunity part that we just talked about, accounts for 42% of frauds in small businesses. Now, payroll fraud, which we'll talk about more specifically, occurs in 27% of all companies, but it doubles in small businesses. So it's close to 60% of the fraud cases relate to payroll. So we'll zoom in on that in a couple of slides and really focus on exactly how that happens and maybe ways of preventing it. So first, let's talk about the primary fraud risk categories. People who are in the fraud detection business look at fraud in 3 main categories here. It's asset misappropriation, it's management overrides, and financial reporting. And I'll define each of these in the next slides. Okay, asset misappropriation, that's the employees abusing their position, again, to steal or conduct fraudulent activities. So some of the things that get done under this category is embezzlement. That's where you're manipulating accounts or making false invoices in order to embezzle money from the company to what the owners think is a legitimate account, but is one that's owned by the individual who's conducting the fraud. Payroll fraud, we talked about that. The most common one, well, actually, there's 2 that are rather common. One is creating fake employees, where, let's say, there's direct deposit, which is rather common. You have a fake employee, but they're direct deposited into an account that that the person who's conducting the fraud owns, or there's fraud with overstating hours. Let's say an employee gets paid hourly and there's more hours listed as payroll than the employee really does work. Last is data theft or intellectual property theft. In this age of technology and more service-related businesses, this is becoming more commonplace. So data theft could be something as simple as stealing customer lists or customer phone numbers or emails in this day and age. Intellectual property is stealing some of the trade secrets of the company. So they're all types of frauds that fall under this asset misappropriation. Management override is the second category of fraud, and I'll call these internal because this is usually where management or employees are conducting fraud to the owners. So I'll call that internal because it's happening within the confines of the company. Things such as backdating financial documents where maybe an expense happened in a current month, in a current month, but you're going to record it in a future month, or there was revenue earned in a future month and you're recording it in this month, just to make the financials look in a certain way, usually better than they are, because let's say management is incentivized and compensated on favorable financials, so they'll artificially adjust certain things with the timing of it in order to make it look more favorable, and hoping that the next month there'll be more revenue and they'll catch up. That's also done in the form of adjusting journal entries at the final close. At the month-end close, there's some adjustments. There's things such as accruals, which can impact the timing of when expenses hit one month to another. That could be manipulated by someone who has the intention to present fraudulent internal financial statements. And approving refunds or voids, again, this is all done in the spirit of trying to manipulate revenue in a certain way to reflect to ownership a look of the company that may or may not be accurate, all with the intention of it being more advantageous to management because they're going to get compensated for it. The third category of financial reporting, I'll call that external. That's the intentionally inaccurate information to lenders or investors, so people who are typically outside the company. You see the logo for Enron. They are by far the most well-known situation where that occurred. That was widespread and encompassed not only ownership, but their advisors as well. It took down Arthur Andersen as well as the company Enron alone, and spurred a whole litany of regulations called Sarbanes-Oxley. So what happened was the financial community was so upset with the fact that this could happen that they really went overboard in regulations, and those were like regulations have been pulled back a little bit, but still quite a bit exists there. So this is a good example of broad or widespread fraud. That a couple examples of that is where you're entering false transactions. So you're indicating that revenue was much higher than it actually was. It's not being regulated or checked. You're creating false entities. That happened in the Enron case where they had separate LLCs that were either customers or vendors, and they just created a rather large network of these false entities to benefit a small number of people. And then lastly, improper recognition of transactions. And this is the timing of transactions, the nature of transactions. Enron was a very complicated case, and there's been courses on it just as an example of the type of widespread fraud that could happen. Again, this is all external. This is where ownership's even involved to fraud either lenders, people who have lent the company money, or investors of the company. since we're talking financial reporting, I think it's worthwhile understanding this as a small business owner. There's 3 levels of financial statements, and some people say, well, geez, why didn't the financial statements catch this level of fraud? And people need to understand the type of financial statements there are, and that there are 3 levels. One is compilation, which is the most prevalent for small business owners. That gives you no assurance as far as fraud. Those financial statements are basically management's representation of what's happening. The accountant who's issuing the compilation report reviews it as reasonable, moves on. So if there's a low level of fraud there, maybe not rampant, it's highly unlikely that preparing a compilation is going to detect any of it at all. And again, compilations are by far the most prevalent level of financial statements that are requested by the banks. Review is the next level. That gives limited assurance. There's more testing that's done, financial analytics that are done. So you're more likely to catch a fraud under that level, but again, there is absolutely no complete assurance that you will. Reviewed financials are usually requested from the bank if, depending on the amount of financing that you have with the bank. Sometimes if you're a contractor, bonding companies require that level. It's a heightened level, more expensive, so small business owners hesitate to prepare those, but in instances that they have a certain lending, usually over $5 million, they have no option but to do that. And the last level is the one that is most common, and obviously all larger companies have this as an audit. Now that gives complete assurance. That is where if there's fraud, that will be caught. Now, again, if it's a small level, probably not, but if it's of any significance, audits do catch fraud. So when you're thinking of fraud and thinking your external accountant is going to find it, it's not necessarily the case unless they're specifically asked to conduct fraud type of internal controls, because the reporting alone won't find that. Okay, let's talk now about common fraud indicators. These are indicators that, if they're in your company, might give you cause to believe there might be fraud happening in your company. And again, to what degree we'll talk about in a minute as well. All right, so one is key employee who rarely takes a vacation. This is an employee who on the surface appears very loyal and very committed, but doesn't take many vacations. That may be a sign that that employee is controlling certain transactions or activities that they don't want other people to know about. Next is consistent expense variances compared to budget. If you do budgets, which people who know me, I'm a big component of budgets, and you're seeing variances on a consistent basis without any real valid explanation, that might be cause to think that there is potential fraud. Frequent policy and procedure overrides. When management has discretion to override certain activities, and at their discretion, sometimes they do if maybe they're in a good mood, and sometimes they don't if they're in a bad mood, and you leave that kind of discretion. That kind of authority could be a breeding ground for fraud as well. Transactions not supported by source documents. These transactions, in a simple example, are usually cash transactions, right? You're told that you did some repairs and maintenance, or you bought, if you're a restaurant, let's say you bought some inventory on with cash, but there's really no support for it. You might not have a receipt for that. That really is a very loose way of tracking those transactions, and again, could be a breeding ground for fraudulent activity. And then missing records or approval signatures. If there is a process where there's a requirement for one level to supervise another, or a level of documentation that's needed as far as records, and they're spotty or missing, again, that lack of control creates the opportunity that we talked about and possible fraud. We'll talk about each of these a little more in-depthly now. Okay, so key employees rarely taking vacation. We kind of talked about that, their fear of discovering a fraud. Other things that fall under that category is if employees rarely delegate tasks. So if they want to keep the whole transaction under their belts, and even though they're experienced and maybe can bring in other people to help them, they still want to hold on to it. It's more perceived maybe as a control thing, but it could be masking something nefarious. Employees not interested in promotion. So again, let's take a bartender who's not interested in being a beverage supervisor. He or she's really happy where they're at. That might be because their income is supplementing in ways that maybe you can't see. Okay, another one, expenses consistently exceed budget. We talked about that a little bit, and somewhat obvious there. If there's variances that don't quite make sense, the problem is, and that's the second arrow down, is if this fraudulent activity has been happening for years and years, your baseline in which budgets are created might be created under false premises because the fraud's already built into your budget numbers. What people do in that instance is a lot of times they'll go outside and see what industry averages are. And if a particular line item is off from industry averages, they might circle back and question it. And that's the way they detect it. Again, when you have a bad baseline, you have to look externally. Frequent policy and procedure overrides. We talked about this. Internal controls in this climate is viewed as discretionary. So if you have a supervisor at, I'll pick a restaurant because there's a lot of cash. They're usually not as much as there used to be. But if the supervisor has the discretion as far as how to allocate tips, or if there's cash in the register, what to deposit, that's a good example of it. And again, I say company cash is loosely handled, and company spending is not monitored. So when there's these cash payouts, and again, it's not viewed there, or if you're paying certain temporary help by cash, they're usually areas that are examples of loose policy and procedures there. And as the owner is removed from those decisions, that gives management more opportunity to do things at their discretion, which again might tilt in the favor of them in a fraudulent context. Transactions are not supported where you don't have the requirements. We talked about payroll, so no W-9s are on file. That would be an example of it. Management doesn't perform TIN matching. This is where a TIN is the number for a particular, let's say, vendor, and they're not matching that ID number matches that actual vendor. So again, there might be some fraudulent activity there, or now we're trying to promote more and more electronic banking, but making sure that the bank routing number and the account number is really that of the vendor is another way of looking at that there's support. Purchase orders is another example of that. Okay, missing records and approval signatures. Again, I think we talked about that with invoices, canceled checks. This is when you're looking at the reconciliations, you want to make sure that there's canceled checks there. Another example of that is lack of segregation duties. Usually small offices, you don't have that many personnel. So when you're trying to segregate duties, it makes it difficult to do so because there's not that many different people there. Okay. I want to talk a minute about the cost of fraud and how much is acceptable. And many owners will instinctively say, well, none is acceptable. I don't want any of it all here in this climate. And that is fine, but small business owners need to understand that there is you have to weigh certain factors in that. So you weigh in this example here the cost of making sure that there's no fraud happening. So you have to add layers of internal controls, which take people and processes and funds, versus what the potential loss could be if there were fraud. So again, if you're not certain there's fraud and you want to put preventive measures in there, that's fine. But you do need to weigh that. It's ultimately the owner's decision as far as how much fraud they will tolerate and what costs they will incur in order to avoid it. So it's weighing the cost of prevention with the loss from the potential fraud. And that is not a set answer. Every owner has their different levels of tolerance with it. and sometimes they'll try to tighten the belts there and tighten up internal controls, but that's not always sustainable because that's where the costs incur. So you want to consider the impact to the company culture. Again, if you're turning on and off again the internal controls, that might seem somewhat whimsical as far as management and the employees. If you're too loose, then that opportunity is always there, and you don't want that. If you're too tight with it, then it's going to be more costly, and you just have to accept that there's going to be a certain level of profits that you're not going to have. Again, that's a judgment call and a very difficult one for ownership to make for sure. Okay, now let's talk about the 7 ways to avoid fraud or prevent it in your company. All right, first is segregation of duties. You want to avoid the same persons handling, let's say, for example, revenue. They open up the they open up the mail and they obtain the check, then they post it, and then they deposit it as well. You want to have one individual handling all of the accounting entries so that you don't have too many hands in the mix there where you can have fraud. So if there's something on the accounting entry side, you could point to one person with that. And you want to periodically review payroll calculations. Since that is by far the greatest area, you want to review and have maybe an outside person determining whether that person really worked the 42 hours that they're getting paid for, or 25 hours, or whatever the case may be. So a periodic spot review on that is helpful as far as, again, segregation of duties. Next is monthly account reconciliations. As part of the close every month, bank reconciliation should be done, and credit card accounts should be reconciled as well. It should be done timely. You shouldn't wait months and months for that to happen. You want to do it timely, so if there is an inaccuracy, it can be caught right away. You want it reviewed by someone other than the preparer. So again, this might be the owner who's doing it or another employee, so that there can't be, it's much harder to have a conspiracy when you have people who are maybe not in the same department looking at it. And occasionally you want to do surprise or spot reviews of those accounts. And many times under CFOonDemand, we're asked to do that. On occasion, we're asked to step up or review some of the reconciliation processes in order to see if there's anything we detect at a certain level. And a lot of times, just the fact that we're looking, they feel that closes that opportunity circle, if you remember in the beginning, that triangle, and therefore can be a deterrent. Third, implement mandatory vacation policies. This touches on that employee who kind of holds on to their tasks. I think of a bartender. That's usually where you see that, where a bartender is maybe giving out free drinks, getting paid for, or bringing their own bottles and doing it that way, or not depositing all the monies. There's multiple ways, unfortunately, that a bartender who handles drinks and a lot of small transactions can do it. So that's usually the example that I've seen and hear about. One way of doing that is have mandatory vacation policies, as well as have maybe employees cross-train. So you can give that person, maybe they're not going to take an extended vacation, but taking days off here or there might detect if there is a problem. Okay, number 4 is you want to secure the physical assets of the company. And this is big and sometimes just overlooked by companies because there might be some costs involved with it. So keeping checks locked away, that's not a very costly problem there. But again, in this day and age, there's less checks and more electronic transactions. You want to make sure that those transactions are accurate. There's not been any changes. So many times you can work with the bank to create some safeguards on that front as well. You want to avoid signature. You want to avoid signature stamps to the extent that you can. If you cannot, you want to make sure that the signature stamps are locked up and only certain people can use them. Lastly, you want to institute inventory controls and cameras as needed. So in companies where there is manufacturing or it's retail in nature, these inventory controls are absolutely critical. Frankly, restaurants too, where you need to make sure that you're tracking the inventory and keeping an accurate list of them. The problem with that is many small businesses use inventory as an area to adjust profits and losses of a company in order to pay less taxes. So, if the business owner is using the inventory as a tool to lower your taxes in a given year and not reflecting it accurately on the books, employees or management see that and say, well, if they're going to have a loose tracking of inventory and manipulate it on their end, well, that'll lead, again, that creates opportunity. And then maybe that's where you're having some problems where inventory is being stolen or sold at discounts and employees getting kickbacks. Cameras are helpful there, but you can't have it both ways. You can't be loose on your inventory so that you pay less taxes in a given year and then turn around and closely monitor it so that your employees are not stealing from you. If you're going to monitor this thing and record it properly, because you got to remember your controller or your bookkeeper is seeing what values you're putting there, and they're ultimately your scorekeeper, you want to make sure that are staying consistent with it. So that's somewhat of a hidden cost. We kind of talked about hidden cost. That's a hidden cost where you're going to pay more taxes or an accurate amount of taxes in order to have controls to keep that under wraps there and an accurate number, especially when you have multiple locations. That's an issue. So I spent a little time with inventory because with certain companies, that's the big problem, is the inventory control, and that can really hurt cash flow. It obviously can hurt profitability. It could also impact morale, and the owners feel that they have to be closely connected with the company because there's just too much going on rampant there. Okay, next is know your employees. And this can be viewed almost as a lifestyle audit or observation. So you want to be alert of key indicators. And again, we talked about the opportunity leads to pressure and then leads to rationalization. This is the pressure part. So if you know an employee is being pressured at home, maybe their spouse lost their job, or their spouse is going through some hard times, or maybe a kid is going through some hard times, maybe some dependency issues, or whatever the case may be, that leads to pressures on the employees that are external in the company, and that might warrant them changing their outlook on their business and maybe their ethics. So you want to look at that. You want to see if there's strong objections to procedural changes. So if you're instituting changes, right, most companies, especially as they grow, have to institute changes, all in the spirit of helping to create an environment where there's a discipline to grow. If you find employees are resistant, that again might be an indicator. And sudden devotion to work, we kind of alluded to that, where they're less inclined to take vacations because they're protecting something that you're not aware of, or they come in at odd hours. That too can be an indicator that something's going on. If they're not there during the normal business hours where they've been in the past. So all those indicators you want, as I usually say, you want to put your antennas up and know what's going on there. Number 6 is automate the payable and the receivable process. The less steps to recording a disbursement, or the less steps in recording the actual receipts of money, the better, because there's less opportunity to have a fraudulent activity happening at those steps. So you see some grayed out areas there as far as the old way of you receive an invoice in the mail, then you post the invoice, you get the approval, then you code it in the accounting system, then you queue it up for payment, you write a check. There's a lot of steps involved there. Now you can automate that, and they have been automated, where you might get the invoice electronically, the approval from the owner may be, again, electronic, and then you're sending out a payment electronically. So that really streamlines what was maybe a 12-step process to a 3-step process. With that is great in automation, but again, your internal controls as far as preventing some of the other items we talked about will need to change as well. It's not like, okay, it's automated, I don't have to think about it. It's automated, but instead of maybe reviewing 3 or 4 potential areas of abuse, you're only looking at 1 or 2, but you still have to look at those and need to understand the sophistication of the level of audits. Just because you change a process doesn't mean the audit risk goes away. It might lessen, but in order to make sure that it's under control with your internal controls, you need to change those controls. So as you change processes, you also need to change controls. So this automation is great, it's efficient, it's cost saving, but it also creates new opportunities, which again, with certain pressures and certain rationalization, is again the breeding ground for fraud. And lastly, you want to set the tone at the top. I kind of alluded to this before. I have business owners who have written ethics policies that they have employees sign from the get-go. There's owners that are that formal with it. And you want to lead by example. And this is difficult, especially with owners who deal with cash and maybe have developed some bad habits over the years of not recording the cash, taking that. They may think the employees don't know, but the employees probably know more than you think, and they figure, well, if you could have your hand in the till, so to speak, why can't I to a lesser degree? How are you going to monitor it? Again, it's a breeding ground for opportunity, and where you're bending your ethics, it's really hard to have that double standard where you can be deceiving, let's say, to the government or to a partner or whatever, but they can't be deceiving to you. It's difficult in that respect. And frankly, I've seen situations where disgruntled employees have come back and said, okay, you have a problem with me, but frankly, I've seen you do this, this, and this. So if you're going to blow the whistle on me, I will blow the whistle at you. It's almost like two people having guns pointed at each other. You want to avoid that whole climate if you can, and a lot of times it just takes 1 or 2 instances where your ethics are compromising your credibility, and it takes a long time to rebuild. Okay, and recap, the 7 ways to avoid fraud. 1 is segregation of duties, where you want to have different people checking on key transactions, monthly account reconciliations of bank accounts and credit card accounts. And again, you want a second level of review of those just to make sure that there's not any unusual transactions or vendors. 3 is mandatory vacation policy in order to flush out if an individual is controlling transaction or a group of transactions to their benefit. You want to secure the physical assets, whether it's checking account in, let's say, a service business or inventory or restaurant business where it's physical assets or frankly equipment as well. You want to know your employees. If you see changes in their behavior because of external pressures, you want to know what's going on there. You want to automate the processes, and again, to streamline it, but again, be careful that your internal controls are consistent with the streamlining of those processes. And you want to set the tone at the top. And again, there's sayings where the fish stinks from the head down. So again, if you're doing external fraud and you want to discourage your employees from doing internal fraud to you, you need to set the example. So that'll be more effective, I think. And sometimes it needs to be where you clean house. If there's problem people, and although they may be beneficial to the company, you have to determine what that trade-off is to you. Under CFOonDemand, we help many clients in areas such as fraud prevention. We also assist them with the financial and analytics of the company. We see business owners struggling with that area, especially owners that are looking to grow their company as the internal accounting department gets overstretched and the owners trying to grow their company The financial analytics tend to be spotty at times and frankly is a breeding ground for fraud as well. At CFO On Demand, we solidify that financial analytics. If you see that off to the right, we turn business owners from just pure operators or firefighters into strategists. They now can focus on growing their business because they feel that their internal house is in order from a financial discipline side and a financial analytics so they can make better business decisions than they would otherwise. The reality is there's only so many hours in a day, and we truly believe at CFO On Demand that business strategists beat business operators all the time, whether you're Wally, Coyote, and the Roadrunner. Business strategists win many more times than business operators. Thank you for attending our webinar. We want to have a word from our sponsor now, which is Merrill Lynch.
Good morning. My name is Ralph Ator, and I'm with Merrill Lynch. My team offers full-service wealth management and are the premier advisors for retirement plans in the Southern New Jersey market. We know you have a lot on your plate, and retirement planning might not be on the top of your to-do list. My team handles customized retirement plans from initial startup to ongoing reviews and maintenance. We work in conjunction with your CPA to ensure you, the owner, receive the most beneficial plan the law allows. Let us help you reduce your stress. Have a retirement plan already? We offer a complimentary benchmarking report on your current plan for pricing, quality, and design. Don't have a plan in place? We can review the various retirement plan options to determine the best fit for your needs. Thank you. We can be reached at our contact information below by phone or email. We look forward to working with you.